Welcome to Roll Right In. This is it, the end of 2023. It was for the financial markets a dynamic year. So today, first, we have a look back. We just wonder what happened in the last 2 months, November and December. And then second, what does that mean for next year, 2024? So this is Roll Right In, brought to you by Max and Tim from Oceanic Partners, a venture firm in San Francisco, along with me, Fabian, from Studio Alpha, an accelerator for software startups. Let's kick it off. Max, what's your take on the last 2 months? So at least for my portfolio, it was very good.
I think that was the case for most retail market participants. I don't think it has been as good of a rally for hedge funds. If you're trying to time some of these movements or hedge them, it can be a pretty frustrating experience. But yeah, I mean, overall, it's been a pretty strong rally starting in November, and that extended out to December. I mean, the overall rally, which is basically on and off, lasted the whole year. It started off with the tech majors, like we've talked about many times, but it has really broadened out fairly significantly more recently, and it pulled up a lot of the names that suffered the more brutal drawdowns earlier. So the tech majors at this point, they're somewhat range bound, but the heavily shorted names, the unprofitable tech names, they have seen some meaningful recovery. And this is in part driven by short covering, but not only. There's, again, healthy retail participation, very significant retail flows. There's just some essence of the animal spirits that are in play again. As far as our market, the private VC backed ecosystem, it's still negotiating a pretty tough environment, but at the very least, the public comp set, it started to find its footing to some degree.
So what is happening? What are the macro factors in play that that we have this situation?
Yeah, well, and again, we've talked about this repeatedly, but everything that has caused the bear markets earlier in 22 and kind of early heading into this year, inflation and rate hikes, the two biggest drivers. Inflation is moderating on a year-on-year basis, at least if you believe the hard data, and the economy and earnings, they're not teetering into recession, and the job market is still more or less resilient and still holding on to pretty key levels. But I would say as far as the November rally and kind of what we're seeing today, I would say the market has begun to really, really aggressively price in rate cuts much earlier than they were before, or at least the expectation of rate cuts. And the market has had bouts of attempting to do this before, try to price in, the timing and the magnitude of the cuts. But, really, we've been living in the higher for longer consensus through about the end of October, when we had, something of a local bottom. And we saw the bear steepener of the yield curve at that point. We saw the 5% on the 10-year, and that basically corresponded to the October lows. But now at this point, it's really trying to, the market is really trying to look ahead as much as it can to to kind of suss out that first rate cut, and it seems like at this point it's just expecting it to be much earlier than previously anticipated.
So since then, there has been an aggressive drop in yields, right?
Yeah.
And Bill Ackman made this announcement on Twitter that he's closing his US bond short.
Yeah, which is obviously huge news.
It is or it isn't?
I think it's pretty big news. I think if we're going to start to see bond prices go up, bonds and prices and yields are inversely correlated. So as yields go down, prices go up. So what he's seeing is a long-term trend towards yields decreasing, which means prices are, ultimately increasing or going to increase. And obviously you don't want to be in a short position when prices are increasing.
So basically, it's good when you have a TLT at the moment.
Yes.
TLT was a very good play, just based on that alone. Which is not to say that Bill Ackman is the last word on yields and bonds, but it was really a good call to make at the right time.
Well, it's just another ingredient in the momentum that we're kind of building towards a brighter future. And I kind of I hear what Max is saying about inflation. From a hard data perspective, looks like it's easing year over year, and unemployment, but it's hard to say that the numbers have been significant. They've been incrementally better, but there's still a long way to go. So it's I'm curious what you guys think about the geopolitical risks that are out there, and how they compare to a year ago, and how that might affect this kind of rebound or soft landing or whatever we're experiencing right now.
Yeah, that's exactly what I prepared here, like as a slide, which comes from Max, namely that we get the December Federal Open Market Committee. When they come out with their dot plots, that seems like having poured more fuel on the fire. I show you now here the slides that are prepared by Max.
I mean, that was really the capstone, I would say, for the big November rally, was the December FOMC. And throughout all of December, and November earlier, I mean, the Fed has been trying to kind of tweak its language, and all of that taken together basically resulted in a pretty significant tonal shift from the Fed, if you will. Prior to December, they were basically trying to sell the higher for longer narrative. They were, I think from their perspective, they were concerned that the market was just easing financial conditions unduly, and they want to get as much mileage as they can out of their rhetoric and their policy. And when the market just simply doesn't believe them, they kind of have to reinforce that through language. And they've been trying to do that up until December. And then in December, we got, again, what basically amounted to kind of this tonal shift. The Fed began to acknowledge the fact that, like, yes, policy, takes time to filter through the economy, right? So if you kind of read between the lines of just kind of the language that the Fed uses, that implies that, at this point, they're in a wait and see stance. So, we've gotten to kind of our target Fed funds rate, and now we're acknowledging the fact that it's going to take time for that to have, full economic effects, and to slow the market down and to slow inflation down. And we, the kind of the corollary of that is that we don't need to, raise rates anymore or as aggressively, right? Or, hold them for, for some very extended period of time. We can now kind of see what the effect of the existing policy is going to be. And then we got to the actual FOMC meeting, and we got, the SEPs, the quarterly summary of economic projections, and the dot plot, which, also comes out quarterly. And, the dot plot, again, we've talked about this before, but it's basically the survey of all the, the FOMC members and the Fed governors, right? Where they individually expect policy to be, in 24 and 25 and going forward, right? So it's basically this scattering, right? And they all have different opinions, but it settles on kind of a certain median. And, just like we saw a significant, hawkish revision for the September dot plot, we got basically the opposite this time, major downward revision in the rate path for the next few years. And the market has been even more aggressive than the FOMC in trying to kind of look ahead and to price all of this in. Over the course of December, the yield curve, it reinverted, swap spreads and, Fed funds futures, they all basically pulled up rate cut expectations. And what was previously, a consensus first rate cut in Q2 was basically pulled into March, right? Which is a lot sooner than really anyone would have expected even a month ago. But among other things, this resulted in again a significant re-easing of financial conditions. Weaker dollar, gold spiking, lower rates. And now we're sub 4% on the 10-year. So the closing out of the bond short was was definitely the right play to do, and it made sense on a kind of a risk reward basis, which is simplistically that's kind of how these hedge fund guys they look at it. But there's clearly something to it.
So Max, could we say that the way equities are reacting, it's really getting ahead of itself? So what's the point on the rate cut happening at any specific time if the market itself just tries to get ahead of it?
Yeah, I mean, there are just certain, it's just the nature of the tools that the Fed has at its disposal. I mean, the way that it basically affects policy is through, very short-term mechanisms, right? So they basically, their purview is, kind of the reverse repo facility, right? And kind of what they pay for repo and SOFR, right? And which are all very, kind of very short-term rates, right? And the market basically does the rest, right? So the Fed, if they're not doing QE and they're not buying long-dated bonds, they're basically staying out of most of the yield curve. And at this point, kind of they're doing QT in an orderly way, right? But the market is kind of doing the rest, and this is all the bond markets and the corporate bond markets and mortgage markets and kind of everything, the entire structure that's built on top of that. But because of this dynamic of the market looking ahead, it was doing part of the Fed's work in in tightening. When tightening was kind of the general market narrative, and you can kind of see that in that slide, right? I mean, the financial conditions, they tightened because of market dynamics, right? And they were doing that, and they were doing the opposite in November. So it can work both ways. I mean, the Fed kind of sets the general, I would say, the general direction of the policy, and then the market just tries to kind of bounce around that. Would be the very simplistic way of saying it.
Okay, so we were surprised by the hawkish September dot plot that came basically out of the blue, and then the same in December, the other way around, a dovish outlook that nobody expected like this, right?
Mm-hmm.
So
certainly surprised.
Exactly, and yeah, that's why we saw the reaction at the stock market. And the question is now the Fed, the way they do these forecasts, when they go back and forth, kind of.
Mm-hmm.
What data is the Fed looking at, and does it warrant this kind of change?
If you just take the Fed at their word, and perhaps the very simple story there is basically true. I mean, when you look at the totality of the data in in the Fed's own language, maybe they just see the light at the end of the tunnel to get to their inflation goal, which is still 2%. They haven't kind of repriced that, and they're gradually shifting from thinking, from kind of nominal rates to real policy rates, right? So at 2% inflation, 5% plus Fed funds would be too restrictive, at least kind of in theory, right? And so now they're just normalizing policy because they see, they see some kind of resolution in sight. And this has been true for the most part. Again, based on the hard data, right? We've seen inflation come down gradually. There are areas where it does appear to be sticky and structural. In the last CPI, we saw wage inflation come in a little bit hotter than expected. So that's obviously a concern for the inflation, narrative and the inflation fighting narrative. We've got other structural drivers out there as well, longer term. So, again, deglobalization, decarbonization. Those generally are thought of as kind of inflationary themes. But in the shorter term, we're definitely wage inflation is the one to look at, and that's kind of a proxy of shortages in the labor market. So we're still not seeing almost 2 million people come back to the labor force from pre-COVID days. So that obviously is still creating some shortages. And
are they ever coming back?
A lot of them, as far as we know, they took that early retirement, so they may not be coming back, right? So you have to either reskill existing workers. You either have to import them through immigration. You have to it's a challenge, right? It kind of at that scale it becomes something of a demographic issue. But longer term, this is expected to be driver of inflation. The labor force is going to be shrinking, and I think those trends have been in existence. We're kind of in an aging society. A lot of developing economies are, but I think COVID sort of accelerated some of those people leaving the labor force. But they were probably 5 to 10 years away anyway. But labor market so far, because it has been very tight, it's still putting up fairly robust numbers, right? So the last payrolls report, we actually got a reduction in the unemployment rate, so we're not crossing over what's considered a pretty important threshold of 4% in unemployment. But it's been moderating. We've seen revisions, pretty significant revisions of prior months reports. We've seen kind of the lower absolute number of payroll gains. So it's cooling, but it's not considered recessionary yet. Surveys and kind of softer data has been holding steady. They've been improving. Like the ISMs. Q4 GDP right now kind of pegged at 1.2%, so well off where we were at Q3, which was 5.2, then revised to I think 4.9 handle or so, but still not recessionary, right? So a Q1 rate cut, kind of in this context, it may seem like really aggressive timing, but it would actually be something of a historical average, right? It takes about 8 months from the final rate hike to the first cut, and that's that would place us right around Q1. But again, the Fed has been using a lot of hedging language as well. The totality of data being very data dependent. So if they see inflation picking up again, for whatever reason, they presumably will be fairly aggressive in fighting it. They know the example from the 1970s. Inflation comes in waves, and if you don't kill it, it can there can be a resurgence. And I don't think that Powell wants to be Arthur Burns. I think he wants to be a Paul Volcker, or at least from a legacy perspective.
Well, okay. So next year is also a election year. Tim, you as a Democrat, correct?
I'm more of an independent.
Okay, you as an independent. Could this election year have anything to do with it?
Yeah, the rate cuts, in the context of stronger macro data, or macro data which has not deteriorated yet. I mean, maybe, right? That's there are rumors like that. I mean, the Fed is ostensibly politically independent, so I would just take them at their word. Tim, what do you think?
Well, I think there's another piece of it that no one really talks about, and a lot of people might disagree with, but
I'm curious.
Donald Trump really took credit for the economy that Barack Obama built. It was Barack Obama came into office, and it was a disaster, and it took him 2 terms to turn it around and get things back on track. And Trump came in on the heels of that, and it was kind of like the Roaring '20s, and he claimed basically credit for everything, and slowly he destroyed our economy. Over his short 4 years, he halted the economy. He stopped people from working. He stopped kids from going to school. He created social dilemmas across the board, and then we came into Biden's term, and Biden, for better for worse, because there's a lot of pros and cons about him that I'm not going to go into. But he had a plate of diarrhea, that he had to work with, and he has had, I think, a great administration and team, and staff that has refocused and remolded things into, a place kind of that potentially is a better future. Obviously things are appearing to turn around. It doesn't look like a hard landing anymore. It looks like a soft landing. Is the election, responsible for some of this? I don't think so. I think the Fed has worked really hard to make a difference and turn things around. Seeing inflation, at least out here in California, it's been pretty excruciating. The prices of things have gone completely non-linear, extraterrestrial in some cases. I mean, gas, I was down in LA a month ago, gas was $7 a gallon. Never seen that before. Milk was up at $10 a gallon, things like that. It's just knowing where it's been for 90+% of my life, and seeing what happened in such a very short period of time. The Fed had to do what they did, and I think it's been effective. But I wouldn't say that the election is a catalyst for kind of what's happening right now.
So you don't share the dovish attitude of the FOMC at the moment?
I'm just, for me, the jury's still out. I think we need more data. I look at, obviously inflation and CPI and unemployment, but then I think about personal savings, and I think about credit card debt, and some of those numbers are pretty close to the worst they've ever been historically. And that's gonna be pretty hard to unwind. I mean, you can forgive student loans and things like that, but high interest rate credit cards and issues surrounding those types of debts, which are affecting the majority of individuals in the United States right now, it's going to be tough to unwind. And if the market responds and we have this continued, coming out of the gate strong and on we go, that's great. That will help resolve a lot of those things. But I don't know. I guess I'm just not convinced that all the data is moving in the right direction right now. I feel like it's kind of an ebb tide right now. So it's, the tide hasn't quite switched, and I'm looking for a few more signals to see the boats turn around and pointing in the other direction.
Okay, so that brings me to the point where I came across the New York Times Deal Book Summit, where they had this interview with Jamie Dimon. So he's also pretty conservative. So he doesn't share this dovish sentiment like Tim. You as a Trump supporter, what do you say to this?
Well, I would call myself non-political for the most part.
I know.
There's not much that I can say, politically that would be a unique insight. I mean, what I would say about politics and presidents, they clearly they like to take credit and shift blame. It's an age-old tradition of presidents, but actually administrations have less to do with the dynamics of the economy than certainly they say, right? We've been in a period of just absolutely unprecedented accommodation from the financial crisis going forward. Those trends have been in play for years, and we've we're still dealing with their consequences. We're still dealing with the consequences of money printing, and again, COVID kind of overlay all of that in a pretty interesting way.
Yeah, you prepared this slide for, you prepared this slide.
Yeah, I mean, I would say, to kind of echo Tim's point, like, yes, I think it's still time to be data dependent, given, what we know from history and what we know kind of inflation can do if you, if you don't completely kind of definitively kill it, right? The numbers, as far as we see them, they've been trending in the correct direction. I mean, can we call this a victory? Then possibly not. The other possibility is that the Fed is looking at maybe they've started to look at data which is not backward looking, right? So we know that they look at inflation indicators and employment, and those are for the most part they're lagged, and they're you could say that they're backward looking, right? And perhaps the Fed is just they're looking forward, and they're seeing indicators that all potentially is not well, right? Given where the market is, I mean, it seems like soft landing is definitely the consensus, but perhaps the Fed is seeing kind of real recessionary and deflationary indicators ahead, and potentially ones that could manifest soon, right? And that could be a number of different things, right? It can be, we've talked about, personal savings exhaustion, right? Just due to inflation and people extending out, or consumers extending out their, all available credit, right? Just to kind of get them through this period. But, that may have kind of a very hard stop to it. Could be a commercial real estate meltdown. It could be, the banking system is still, sitting on major unrealized losses after the last couple of years. Geopolitical instability and political instability, right? I mean, it could be a very contentious, election year, which it could be contentious enough to unsettle markets, right? This kind of thing could come from abroad. It could be, China, kind of assuming a more aggressive stance toward Taiwan. And I think, Xi recently, they had some sort of a conversation with Biden, and he alluded to the fact that, China will be reunified, which would obviously create, quite a bit of chaos. I mean, that might not be the kind of thing that the Fed specifically looks at, but it's just another potential source of instability. There's also just kind of a global slowdown, generally speaking. So, perhaps the U.S. does not need to be in a recession itself for the world to kind of enter into this disinflationary phase, right? So, China is dealing with, what is effectively a balance sheet recession, and their property sector basically melting down. The EU is stagnant. So there are a lot of factors that kind of take the wind out of the sails of general global inflation, if not necessarily in the U.S. If you look at leading indicators, they've been weak, right? And this is the chart that you've got up on screen. They can basically change course very quickly, but at this point they're consistent with what may be potentially a mild recession. But again, if easing financial conditions persist, that can turn around fairly quickly.
Okay.
But rate cuts don't happen in a vacuum. I think that's the overall theme.
Yeah, something needs to be broken. That's
it not necessarily, right? Again, if we're just like I said, if the Fed is shifting in how it approaches rates and starts thinking about real rates as opposed to nominal rates more, and that becomes the focus, then yes, I mean, they would just reduce rates because inflation is simply not as high as it has been, and you can't keep rates at 5% wherever they are without being overly restrictive, right? So it could just be a kind of a normalization of policy given the data at hand. but it could be something that they're seeing that that we're not, right? I mean, it could be a banking crisis that they're trying to get ahead of. I mean, this is basically speculation, but yes, I mean, if they're anticipating, some sort of major financial event, that could inform their policy stance. They've been telling us throughout this entire hiking cycle, that they're going to be very conservative and, very attuned to actual hard data as much as they can be without trying to get ahead of trends. But no one's saying that they can't do that either.
Well, so the stocks behave as if there are rate cuts and no recession, right? And so as people now expect, if there is a rate cut in Q1 or early Q2, when do you buy more stocks? So in other terms, when do you need to buy the first rate cut? Is it right now, or when is it?
Well, that's I mean, that is the $1 million question, right?
I don't know. I think we've seen the economy kind of go from raging bull at the end of 2021 to practically in shambles, over the last 2 years. And I think the intelligent investor has been doing their work and looking at the fundamentals of companies and legging into those companies that have enough cash to survive, that have a business model that's efficient, that is potentially going to continue to grow and be profitable. But the last 6 months has been a really ideal time to leg into equities, whether they're public or private. I think you wait until a rate cut and you potentially have lost a large amount of the potential upside that you could gain. I mean, you can't predict when the market is going to turn, and it could stall, and because of, as Max said, some geopolitical constraints and around the election, it may push it out to 2025. But I guess that also begs the question of what's your time horizon. If you're looking for investments with kind of a 5-year time horizon, now's probably a pretty good time to be digging in and making those calls.
I mean, to the extent that this has been studied, and it's obviously a burning question. It's very context dependent. Looking at the history of the last 40 years, assessing what markets do after kind of the first cut, after the last hike, there's a pretty wide range of possibilities. But all else being equal, first rate cuts without a recession, they generally portend good performance, at least for the first year after the cut. If there is a recession, that could portend a pretty significant drawdown, to the tune of 20%, right? As you would intuitively expect, right? So, just based on those very kind of limited inputs, your outlook on whether there will be an actual recession would be the key consideration, right? A recession does not seem to be the consensus view right now. Forecasts, bottom-up forecasts.
This one, right?
Yeah. I mean, like it. If there is no recession, then you're looking at pretty healthy market performance. You're looking at a pretty strong rally. You're looking at multiple expansion, and you're basically looking at the opposite of that. If there is, rate cut, and that is actually followed by recession. So you kind of have to take your position. Whether this is actually a good time, or whether you're looking at a bear market for at least the next year, right? If there is a recession, but again, that's not consensus. If you look at bottom-up forecasts for the S&P, it's pointing to a really strong 24. I think it's something like 12% growth so far, and this varies depending on who you listen to, but that's well above average. And I'm sure this is going to get revised down as it tends to do, but it's it's not the view of the street, so to speak, that there is going to be a recession that actually creates earnings recession. So real recession would definitely be an impact to earnings, and it would definitely be a change of narrative, and it's by no means priced into the market.
Okay, so you say, so we see that macro has been pretty resilient. Then you talk about this plus 12% EPS growth, which is, so to me, it feels huge.
It is huge. Yeah, well above average. I think average is about, well, don't know the number off the top of my head, but it's well above that.
I'm gonna guess 4.
I think it's closer to 8, but I need to check.
Okay, so a Q3 earning calls, many companies acknowledge the resilience of the consumers on the one hand, and on the other hand, there are some that just many express this concern about forward demand and talked about the consumer, the saving rates at all. Hang on.
All-time lows.
Yeah, exactly. That it's basically they are out of munition.
Yeah, I mean it's certainly something that I'm looking at and a trend that I'm following, and it does seem like there are just purely mathematical limits, right? To if you're drawing down on savings, there's a floor to that, right? And presumably you'll use debt to whatever extent you can to kind of keep consuming, and people have been, debt consumer kind of credit balances have been expanding as you would expect. But yes, I would agree that the bottom up forecast for EPS is ambitious. We also know that they have the tendency to drift down over time. This has happened with both 23 and 24 earnings, right? And if you kind of look at the chart up on the screen for Q4 23, there was a major kind of revision downward to where analysts expected that to be. And, there's really nothing stopping from 24, being revised down in a similar way. And the top chart, I think, is pretty interesting, just very reflective how these how these forecasts can just drift down. So yes, I would say that they're fairly ambitious right now, but that it's just part and parcel of how the street operates.
Okay, Tim.
Yes.
As far as I just read in the news, that people think that the US is capable to avoid recession. They see lower rates. Why ever? Max, again, we don't know at this point why they should lower rates if there is that they can avoid the recession. But if this is all true, then there will be a strong year.
Yeah, I think that all lends itself to the idea that the Fed has been successful in engineering a soft landing. One of the things I'm pretty curious about is how retail spending ends up in Q4. With most of the individuals that I speak with, they have really cut back on their spending, for the holidays this year, and it's in a tangible way. I think this is the time of year when a lot of families spend too much money. They take trips to who knows where, around the world, and buy presents
Rainforest,
that they can't really afford. Yeah, exactly.
like you.
Not like me. I'm not going anywhere. But I'm curious to see if the belt tightening that I personally have been kind of talking about and predicting over the last year realizes finally this quarter. And if it does, I think that's meaningful. And I think the Fed, I do think the Fed has done a great job. I think it's been really painful for most people to see those hikes continue and to see how it's affected their lives in a material way. But if the goal was to engineer a soft landing and not go into a real recession, not have a hard landing, et cetera, then to me, that's a huge success. So I think they've done a good job.
Okay.
Yeah, I mean, they always do a good job until something blows up, but we don't.
Oh, Max.
Well, it hasn't that generally been the case, right?
Isn't that the way it is with anything? It's always great till it isn't.
Yeah, and perhaps we'll be having a different conversation right at the end of 24, but maybe not, right?
Yeah.
There's a number of saving graces, right?
But I still have
Maybe
a
Trump
question.
will get back on the ballot in Colorado.
Maybe we'll get a sweeping Republican tax cut. Who knows? I mean,
Definitely.
but like I would say, just politics aside, right? I mean, the election will be interesting. It'll be interesting if that actually creates enough chaos to impact markets, right? And this has also been studied, right? Depending on whether it's a Democratic winner or a Republican winner, the markets, it does have an impact on the markets, but I mean, really, it's kind of it's policy centric, right? But at the end of the day, it's basically a wash, right? So it kind of creates an impulse either to the upside or to the downside, depending on the whether the administration is perceived to be pro-business or not. But then it ultimately just kind of settles on the on the long run average, if you will, just because presidents ultimately have less impact on the real economy than they certainly say.
Well, the reality is people can only think globally and act locally. They're not able to act globally.
No, they certainly cannot. But I mean, even that aside, I mean, what could be kind of a saving grace for the market? I mean, yes, it is. It's the consensus view still that we're getting a soft landing. If we do, great. I mean, then we get to the first rate cut and the market.
Well, why exactly? That's still the thing I don't get. So if we have the soft landing, as Tim also mentioned that Paul did a great job, and it's likely that there's a soft landing. So why, as you mentioned several times during this year, Max, why then should I, as a Jerome Powell, why should I cut rates? Why should I just cut rates if they have a soft landing? Everything is fine, and
well, at some point, if you're selling debt instruments, if you're the U.S. government and you're selling treasuries or other debt instruments, you do want the price to be you want it to be higher. You want to bring in more money, and you want your coupon to be lower. Debt service becomes an issue at some point if the yield remains high for too long. Does that make sense?
That's why they lowered the rate.
Yeah, countries will run out of money. They can't service the debt.
Yeah, I mean, if
but that's then will so if they just cut rates so that they can pay their debt, then we will have inflation again.
Well, no, not necessarily. Inflation doesn't just come out of nowhere. Max can talk about this, but there's a lot of drivers of for inflation and how we got to where we are today. But if they can mute the inflation and bring it down to their target level, which there's no guarantee that they can, it is then time to lower rates.
I got it, because the credit cards are empty. We have a soft landing, and now I can cut rates because the consumer don't have money anymore.
Well, that's part of it for sure. Yeah.
That's very
Yeah.
simple.
It's tough to consume, yeah, when you're just out of money.
You have no money. Tough to be a capitalist with no
Okay,
capital.
Yeah.
that means for the three of us that we now, when we stop this conversation, we buy more stocks.
Yeah, and hopefully over the last year and a half, you've also or investors have also purchased some good bonds. Some highly rated paper that is going to provide them with a consistent income as well, just on that coupon, because the yields have been extraordinarily high historically, at least for the last 20 years.
Yeah.
I mean, that's certainly part of the market doing what it was doing, right? A 5% bond is meaningful, right? And it's a change, and it creates, definitely changes the dynamics in the markets. But I mean, to the point that you made earlier, like, why does Powell need to cut rates at all? I mean, if the Fed comes out today and says that we think that 5% Fed funds rate is just the long-term rate going forward, I think the market would absolutely collapse. I mean, there needs to be kind of a light at the end of the tunnel for how the market perceives rates, right? But if it doesn't, right, if they just these are the rates, and these are the rates forever, then the entire yield curve moves up, right? It potentially just it steepens with a much higher floor, in which case you're seeing 10% mortgage rates, you're seeing 30-40% credit card APRs. That just becomes the rate environment, which would absolutely destroy everything, right?
Well, I think Fabian, what Max said is really important if you think about it in the context of your question earlier. Perception is reality. No matter what you say, like, your perception is your reality. The market's perception is its reality. And if the market perceives that there's a light at the end of the tunnel because of what the Fed is signaling, that lately, obviously the dovish stance and messaging, that is going to move the market, because that perception has changed.
Yeah, and
Is this a sustainable sentiment? Because they're pretty moody.
No, it's not sustainable unless it occurs over a time series that's meaningful. If this sentiment is consistent over the next 9 months, I'd say absolutely. But yeah, if they flip in a quarter and all of a sudden go hawkish again, everything gets thrown off.
Yeah, and it's happened, right? This happened in September, and this happened again in December, right? So perception is incredibly important. Again, getting back to this point, right? Like, if they say these are the long-term rates, we kind of have another September just on steroids, right? I don't think the market will bear that. I think the common understanding would be that rates this high with moderating inflation will cause a recession, right? And so the bond markets would do what they would do, but it would be very chaotic. And again, the rate markets and money markets, they're vast and they're fairly intricate, right? So the Fed is trying to do a pretty large and also delicate job, and so far, the numbers are trending in the right direction.
Okay.
Getting more data is important, but there are things that can support the market and the real economy in 24, right? Maybe this kind of gradual easing of financial conditions, it will unfreeze certain markets, right? It will help out, commercial real estate folks. It would unfreeze, real estate to some extent, right? It's just generally easier for the consumer with kind of moderating rates, right? Another interesting question that people have been discussing recently is what happens with the money that's been accumulated in the money markets, the money market funds, right? We've seen quite a bit of deposit outflow from from depository banks into money markets, and money markets generally, they just picked up a lot of asset flows, and now they're at all-time highs. About 6 trillion, I believe, is kind of locked up in money markets at this point. So
where is this money going next year?
Yeah, I mean, currently it's being held back by attractive rates, right? So you can keep money in the money market, and you can pick up, essentially the Fed funds rate, which is meaningful at this point, right? But if you start to lower rates, and specifically lower, the short-term rates, kind of the money market rates, where the Fed basically has its domain, right? Some market observers have been speculating that some of that money, not all, all can't, but some meaningful portion of it would flood the equity markets, just looking for returns, looking to basically buy anything that's not nailed down. And you start with yields, and then you kind of move up the risk ladder, right? If you take the other side, if you take the recessionary view, you could argue that these funds might find a home in longer dated bonds, just as kind of a safe haven. But with kind of the long bond issuance that the government is going to have to do over the next few years, or for the foreseeable future, I think they might actually prefer that be the case. But yeah, again, it all depends on what your recession outlook is for 24.
But now, if we just sum up what we have been talking, then it's a good sign. It's good news for the private market. That is kind of lagging behind. So all that money that is parked in the money market funds, rates will go down. So they tend to probably go into the private markets. What do you think, Tim? Are you ready?
I absolutely. I think it can go in multiple ways. I think companies are going to be able to refinance their debt at lower levels, which is going to be a good thing. I think pricing largely, not in every case, but in the majority of companies, has adjusted more along the lines of fundamentals as opposed to just absolute hype. I'm not saying that it's necessarily value investing in the private market, but it's certainly the most attractive market that I've seen since probably 2009, 14, 15 years ago soon. So there's certainly a lot of potential, but there's also some pretty big pitfalls. The private markets lack information, and without information, investors are hobbled from making the best investment decision that they can. There are ways that they can obtain information, and I think it is critical that they do that in any given investment that they make. So I do think, and we have seen our market pick up over the last couple months as the public market has picked up.
We saw it on Bloomberg TV.
It hasn't picked up nearly to the extent the public markets have, but I wouldn't expect it to. It lags behind anywhere from 3 to 9 months in some cases. But yes, I do think it flows also into the private markets, and if this is sustainable, it will be a very good thing for those investors that take advantage of it, that do their homework, that do their diligence, and participate at these levels.
Yeah,
Matt,
but it's still a tough environment, though, Tim. You have to agree. So we're still waiting for that pickup. If we get to that environment of
so
kind of
we're
lower
not too
rates,
late. We're not too late to jump into the game.
we're not too late. I mean, as far as the private markets are concerned, it's still fairly disrupted. It's probably more disrupted on the primary side of things at this point. Although the secondary market it's recovering, but it's still it's still fairly tough.
Yeah, companies have been quicker to lay people off than raise capital at a lower valuation. But we're starting to see it. It's happening, and I think I completely agree with you, Max. It's been more focused on the primary. Companies are waiting for a better environment, and some will make it that long, and others will have to capitulate.
Yeah, I mean it's the entire capital life cycle and flywheel that's disrupted. And again, we've talked about this many times, but there are very few IPOs happening. There's pretty weak IPO performance. There's very low VC distributions. There's slower fundraising for VC funds. There's just a slower. But yeah, I mean the private markets, it's really the capital life cycle and the capital flywheel that I think is really the most important driver, and those remain pretty significantly disrupted, right? There are very few exits. There's few IPOs. The IPOs that have been happening, they've been fairly weak. There's low, VC distributions to their partners, which means there's less fundraising on the VC side. There's just slower funding in general. There's lower valuations. Clearly, there are bright spots, right? You've got obvious market leaders and monopolists, and you've got AI. You've got certain unique situations, but certainly not across the board, and not without specific caveats and qualifications. But on the whole, and again, not surprisingly in this context, valuations and deal volumes, they continue to come down, as you kind of see in this slide here. Those exits that do happen, whether they're IPO or acquisition, they can come in pretty well under their kind of private valuation high watermarks. Down rounds, they remain quite elevated. Yeah, I mean, those exits that we've seen happen, whether M&A or IPO, not very strong performance. I mean, they can come in pretty significantly under their kind of private valuation high watermarks. Been some pretty notable examples. Klaviyo of the recent group of IPOs is the one that's arguably holding out the closest to their private valuation. But down rounds, they remain elevated. Coming down a little bit, but depending on what data source you use, it's still quite high as expected. And like we've talked about before, kind of the startup extinction event, that's we're seeing real evidence of that happen, right? Real indications of increased startup mortality, just kind of across the board. Some areas that have been
very sad.
It is sad. Yeah, I mean, these are all ambitious little projects and smart people and a lot of hopes. And this is companies just being shut down and not finding an acquirer necessarily, and you're just seeing more and more of that, and it's certainly borne out by the just personal anecdotal experience. Some areas in the private markets that have been to this point pretty well insulated from much of these disturbances, like very seed stage and very early stage investing, that is beginning to kind of experience some of these dynamics, right? So you are seeing this kind of percolate down through the entire ecosystem. And Tim, maybe chime in here, but as far as the secondary private markets, it I would say they are starting to recover somewhat, but slowly, right? Pricing recovery is far from universal, but I would say more institutions are beginning to re-enter the market, and offers are beginning to converge with bids, and more deals can basically clear. And many high quality companies, they remain 50 to 60% discounted to their to their last venture rounds.
So you see recovery for next year, less mortality rate, a lower mortality rate, and yeah, as you mentioned, it's a good starting point to get invested in these companies.
Yeah, well, the public markets, given where they are, high comps help, but I would argue that alone is just not enough, as we've seen throughout this whole year, right? We have not really seen the public market rally mirrored across the board in the private markets. Certainly some pockets of them. Clearly AI is the one obvious standout. But really, it's the capital life cycle and the capital flywheel that needs to start turning over again and consistently, right? We need to get those marquee name IPOs out there and happening and performing, reasonably well. VC funds, they need to return cash to investors. They need to raise new funds. And these are all pretty gradual processes. There's going to be a range of outcomes depending on what company you look at. I mean, there are clear segment leaders. There are kind of the monopolies. There are the thematically hot names. There are companies that are on top of every single IPO watch list. Those you would expect to remain quite active, kind of in the secondary markets, and they would probably be the first ones to respond to, sustained market rally. Other companies will recover with probably a greater lag. It took the better part of this entire year for public market laggards, the shorted names and the unprofitable tech names, to begin catching up at all with the market leaders. And, there's reason to believe that the private markets will kind of emulate this dynamic in some sense.
Well, and one thing to just note, based on everything you just said, Max, that people also don't talk about enough, but it's something that we've really realized over the last couple of years. The companies that are surviving, not necessarily thriving, because maybe their business model isn't that great, maybe they don't have a product that is on a path towards profitability, whatever, but they do have somebody that is extremely capable of raising capital. You have these very unique individuals that can get out there and raise, tens of millions of dollars for their companies, and those companies kind of end up floating to the top. It's not necessarily that they have the best business. It's that they've got someone or a team of capital raisers that is much more capable than most of them out there. Because we've seen some great companies that have all the check marks in all the boxes that you would think, oh, this is
unable to raise money.
Unable to raise money. Yep. And
what a pity.
And then they're gone.
Yeah. Well, I mean, if narrative driven investment, the VC markets is kind of where narrative driven investing exists, right? So if you're a good storyteller, that gets you very far ahead of the game, right? I mean, these companies, in many ways, they're basically potential, right? It's basically the idea that you sell, and companies that are really, in many cases, great on fundamentals. Yes, I mean they should make for good investments, but in the VC markets, they are in many ways story driven and theme driven, right? And now just the theme, we know what the themes are at this point. Other quality businesses, they will persevere. They might not be the first ones to recover in kind of a sustained, secondary market rally. but they're certainly out there and they're available and they're significantly discounted in many cases. And then you have the high flyers that can raise that capital and can tell that story. But that I also think is just it's an inherent kind of thing.
Adam Newman should probably open up a school for startups that are not capable to raise money.
Yeah, him and our buddy, Mr. Kalanick.
Yeah, I mean they have the networks. They can sell the idea. It's a very important quality to Marshall. But again, for the time being, this is perhaps a silver lining if you take the investor perspective. The private markets, both on the primary and the secondary side, they've become much more investor friendly than they have been in prior years. And so, if you're an investor and you're kind of considering your options, it's just a much friendlier environment for you. So something to consider.
Yeah, when he says friendly, valuations are lower, terms are better. There are a number of terms and conditions in any primary capital raise that in a great environment you will not see in a term sheet. Liquidation preference is one of them. If capital is free, you'll barely see a liquidation preference, but when it's really hard to get capital, you'll see as much as a 3x, and that means that the investor will receive 3 times their investment amount before the common shareholders get any money back, and that's huge. It's not something that companies want to do, but in an environment like this one, they have to. We're hoping things continue along the same trajectory in 2024, and if we do see a sustainable pattern, we do feel like the private markets will follow suit.
Thank you very much, Tim. Happy New Year.
Happy
See you next year.
To you and yours.
Bye.
Indeed.
Ciao.